Bull Bear Buzz podcast for decoding markets, fueling minds.
Welcome to the deep dive. Today, we're really digging into a fund lots of people ask about, the Parag Flexi Cap Fund.
That's right. We've got the latest numbers here, specifically the monthly report from March 31st, 2025, and also their March fact sheet.
Yeah, so consider this your inside look. We'll try to break down what's actually going on with this fund using this fresh data.
Exactly. The mission today is pretty simple. Give you a clear view of the fund's makeup, its strategy, key metrics, all as of, well, the end of March 2025, and hopefully without getting lost in jargon.
Okay, let's kick off with the basics. What is the Parag Flexi Cap Fund exactly? The sources say it's an open-ended dynamic equity scheme. What's that mean for us?
Well, open-ended just means you can put money in or take it out pretty much whenever.
Yeah.
Equity scheme means it mostly invests in stocks.
Right.
And dynamic. That means the fund managers have, flexibility. They can shift the investments around based on market conditions.
Got it. And its main goal, what's the objective here for someone investing?
The big aim is long-term capital growth, so growing your money over time. They do this mainly through equities, stocks, and related stuff. And they have to keep at least 65% invested in Indian equities.
But here's the interesting bit, right? It's not just India. There's that flexibility we mentioned.
Precisely. That's a key point. They can invest up to 35% of the fund in stocks from overseas companies. Plus, they can also put some into domestic debt or money market instruments. That international option is, well, quite a standout feature.
So they're definitely fishing in more than one pond, it seems. And this fund isn't new, is it? It's been around a bit.
Yeah, it has a decent history. The launch date, or date of allotment, was way back on May 24th, 2013.
Okay.
And to measure how they're doing, they mainly use the Nifty Y500 Total Return Index, the TRI, as their benchmark. They also look at the Nifty Y50 TRI.
That TRI bit is important, yeah. It includes dividends.
Exactly. Total Return Index means it counts both the stock price changes and the dividends paid out. Gives you a fuller picture of the actual returns.
Right. So let's jump to the end of March 2025. What did the actual asset mix look like then? How was the money spread out?
Okay, so the biggest slice, about 64.77%, was in what they call core equity, mostly Indian stocks.
And then came that international part we talk about.
Yep, around 10.70% allocated to overseas securities. Like we said, that's a key thing if you're looking for some global diversification through this fund.
Then there's this category, arbitrage and special situations, just about 2.6%. It lists some big Indian names. What's that about?
Right, so in there you see small amounts of Reliance, Bajaj Finance, PCS, Bharti Airtel, SBI, and some others.
Mm-hmm.
Now, given these are pretty small percentages individually, and we also see them listed in the derivative section as short futures, it strongly suggests this is part of an arbitrage strategy, basically trying to make small profits from price differences. The short positions likely hedge those bets.
Interesting. So maybe getting a little return while trying to keep risk low there. What about the safer stuff, debt and money markets?
Yeah, a decent chunk there. Around 10.87% in debt and money market stuff. That breaks down into about 10.92% in certificates of deposit CDs and about 0.77% in treasury bills, T-bills, generally lower risk.
And finally, cash. They were holding quite a bit of cash too.
That's right. Cash and equivalents, including TRPS, that's a type of short-term lending, tri-party repo plus net receivables, it all added up to about 13.66%. The TRPS alone was around 11.21%.
Looking at all that, what jumps out is the combined cash, debt, money market, and even that arbitrage part. It adds up to a pretty big chunk, doesn't it? Like a lot of readily available funds.
It really does. You combine those, and you're looking at roughly 24.5%, almost a quarter of the fund.
Wow.
And the fact sheet mentions this. The managers see this as dry powder, basically. Flexibility to jump on good long-term investments when they see prices they like.
So a patient approach, not feeling forced to buy all the time.
You just like it. Wait for the right pitch, you could say.
Okay, that gives us the big picture on allocation. Let's zoom in on the Indian stocks, the core equity part. Who are the top holdings within India?
Sure. Looking at the March report, the biggest Indian stock position was HDFC Bank at 8.38% of the total fund.
Okay, big bank.
Then Bajaj Holdings and Investment at 7.10%, Coal India at 6.01%, Power Grid Corp at 5.99%, and ICICI Bank at 5.05%.
Just looking at those top five, you see banks, finance, energy, utilities. It's not all tech or all one thing.
Exactly. Show some diversification right at the top. And if you look further down the list, you see other sectors represented too.
Yeah.
Like ITC for consumer goods, Maruti Suzuki for autos, HCL Tech for IT. So yeah, they're spreading it around the Indian market.
Now, let's swing back to that international side, about 10.7% overseas. Which specific companies are they holding there?
Well, it's heavily weighted towards big U.S. tech names. Meta, Facebook was the top holding at 3.12%.
Right.
Then Alphabet, Google's parent, Class A shares at 2.67%, Microsoft at 2.52%, and Amazon at 2.39%.
So really the giants of U.S. tech. Interesting focus. What might be the thinking there? Just betting on continued dominance? Or maybe balancing out the Indian holdings?
It's likely a mix of things. Belief in the long-term growth of these specific companies, their global reach, the innovation, and yes, probably also getting exposure to sectors or types of companies that aren't as dominant, perhaps, in the Indian market. It adds another layer of diversification.
Makes sense. Okay, let's shift to the safer side. Again, those CDs and T-bills. You mentioned safety and liquidity. What about the quality of those CDs?
Yeah, the report shows many of them have high credit ratings. You see things like iShare A1 plus iShare A1 plus us. These ratings basically mean there's a very low risk of the issuer not paying back. So it adds a layer of safety to that part of the portfolio.
And are these locking up money for a long time?
No, not really. Looking at the maturity dates listed, they mostly seem to mature between May 2025 and March 2026, so relatively short term.
Which means they can get that cash back reasonably quickly if needed.
Exactly. It helps them stay liquid, ready to deploy cash into stocks if they find something attractive, while still earning a bit of return safely.
We mentioned derivatives for arbitrage. Are they using them much beyond that?
Well, the report shows they do use derivatives, mainly through short positions in index futures and stock futures.
Okay.
And like we noted, the underlying stocks for many of those short futures are the same names we saw in the arbitrage bucket: Reliance, Bajaj Finance, etc.
So it ties back together. Hedging or arbitrage mainly?
Seems that way. It's likely a combination of hedging, so protecting against potential drops in their main stock holdings, and also pursuing those arbitrage chances. A short future lets you potentially profit if the price goes down.
So it sounds strategic, not just wild speculation. What's the overall size of this derivative activity?
The report mentions the total outstanding exposure in derivatives was around 239,646 lakhs rupees as of March end. But again, the key message from the fund house seems to be that this is primarily for hedging and arbitrage, not for making big directional market bets.
Right. Okay, for the number crunchers listening, let's hit some key performance indicators. NAV net asset value end of March.
Sure. For the regular plan, the NAV per unit was 78.8834. For the direct plan, it was higher at 85.8001.
And that difference is usually down to costs, right? The expense ratios.
Exactly. For March, the regular plan expense ratio was 1.33% annualized. The direct plan was quite a bit lower at 0.63%. That's the annual cost of running the fund, basically.
And what about risk metrics? Things like volatility.
Okay, so the standard deviation, which measures that volatility or bumpiness of returns, was 10.64%. Importantly, this was lower than the benchmark Nikkei 500's 14.81%.
So less volatile than the broader market, it seems.
Yeah, suggests a smoother ride, relatively speaking. Then there's the Sharpe ratio, measuring risk-adjusted return that was 0.85. Generally, higher is better there.
And beta, how sensitive is it to the market?
The beta was 0.63. A beta less than 1 like this suggests the fund tends to move less dramatically than its benchmark index. So if the market jumps 10%, this might jump, say, 6.3%, and vice versa on the downside.
Okay. And information ratio, trainer ratio.
Information ratio was 0.28, suggesting some skill in generating returns above the benchmark for the risk taken. Trainer ratio was 0.14. These just give different angles on risk and return.
What about portfolio turnover? How much buying and selling are they doing?
Good question. The portfolio turnover ratio, including that equity arbitrage trading, was 26.47%.
Okay.
But if you strip out the arbitrage part, it drops significantly to just 12.98%.
So the core holdings aren't being traded that frequently. More buy and hold for the main part.
Seems that way. The lower number suggests less churn in the core long-term equity portfolio.
All right, that's the snapshot. How has it actually performed over the years? Let's look back.
Since it started back in May 2013 up to March 2025, the fund's compounded annual growth rate, or CAG, has been pretty strong. It was 19.04% per year for the regular plan and 19.89% for the direct plan.
And how does that stack up against the benchmarks?
It's outperformed. Over that same period, the Nifty 500 TRI gave about 14.93% CAGR, and the Nifty 50 TRI gave 13.63%. So yes, significant outperformance over the long term.
That's impressive. What about shorter periods like the last few years?
Generally, yes. Looking at the 1, 3, 5, and 10-year numbers leading up to March 2025, the fund, both regular and direct plans, tended to outperform the benchmarks. The amount of outperformance varies, of course, depending on the specific period you look at.
And they show SIP returns, too, for regular investors.
Yes, the fact sheet does include performance data specifically for systematic investment plan investors since inception, which is useful if you invest that way.
So performance looks good historically, but what's driving the investment choices? What's the underlying philosophy?
They really hammer home the value investing approach.
Okay, buying things cheap.
Well, buying things for less than they believe they're truly worth. They focus on three main things. First, the quality and integrity of the management running the company.
Right, people matter.
Second, the quality of the business itself and the industry. It's in things like profitability, competitive advantages, barriers to entry. And third, crucially, valuation. They want to buy these good businesses, but only at what they consider a reasonable price.
And they're not trying to time the market day to day.
No, they emphasize a long-term view, focusing on business fundamentals, not short-term market noise.
There was one other interesting point, skin in the game. What's that referring to?
Ah, yes. This is something investors often like to see. As of March 31st, 2025, the people classified as insiders, likely the key fund managers and people close to the fund house, had invested a combined total of 459.59 crores rupees into this very fund.
Wow, that's a lot of their own money.
It is. It means their own financial outcomes are directly tied to how well the fund performs for all the other investors. It aligns their interests,
Definitely. Okay, so let's try and wrap this up. What are the main takeaways from this deep dive into Parikh Flexi Cap Fund as of March 2025?
Well, I think we've seen it's a fund with a distinct, flexible mandate. It invests significantly in India, but also has that notable slice of international, mainly U.S. tech stocks.
Yeah, that mix is key.
Right. They also use arbitrage, likely for hedging and incremental returns. And importantly, they were holding a substantial amount of cash and near-cash instruments, suggesting a patient, opportunity-driven approach.
And all guided by that long-term value investing philosophy, with management having considerable skin in the game.
Exactly. That sums it up pretty well based on the March data.
Yeah, and it's really important to keep in mind, this is just a snapshot from March 31st, 2025. Funds change, markets change, holdings, performance, it's all dynamic.
Absolutely. Which leads to maybe a final thought for our listeners to chew on.
Go for it.
Given this fund's unique structure, that international flexibility, the value approach, and that significant cash pile right now, how do you think it might be positioned to handle whatever twists and turns the markets throw at us next, both the challenges and the opportunities?
That's a good question. Something to think about in terms of your own goals and research, for sure.
Definitely worth considering.
Okay, before we close out, the necessary reminder. This story is for educational purposes only. We strongly advise investors to check with certified experts before making any investment decisions.